there, folks, and welcome into this video here today. So videos like this are every once in a while. I just got to talk to the camera and tell you guys about a few things to kind of warn you about some stuff that's going on in the market, some things I'm seeing that I think are definitely worth referencing as somebody that's been doing this for a long time, so you don't kind of get caught into a few traps that are going on out there that are kind of being set up. So yeah, I hope you guys enjoy this as always, okay? First thing I thought I would address this because it has been something I've seen the last few months, and I want to make sure you guys don't fall into this kind of, I call it a time suck trap, essentially. And it's also just a bad place to be mentally, is one, I see a lot of hate on stocks right now, and I see this across a wide range of stocks in like forums or Discord chats or other places where people will come in to hate on a stock, and they're not even long that stock or short that stock. They actually have no position. But the reason this goes on sometimes, and this is not the first time I've seen this in this sort of market, the reason this goes on sometimes is sometimes other folks' stocks are doing bad, let's say, at a given moment, right? And so it's some people, it makes them feel better to come in and hate on another stock, right? And try to bring the people down that own that other stock out there, right? It's natural. It's human. It's human stuff, right? Like some people feel good by bringing another stock down or trying to talk it down and things like that, even though they have no long position or short position. And it's much more likely to happen if you've been going through a tough time with other stocks, right? It's much easier to come out and hate on another stock and make fun of that stock, especially if that stock's doing good at a given period and your stocks haven't been doing good, right? And so don't fall into that trap. It's just that's one of those things. It's a waste of your time, and you don't want to get to that mental place because you end up just kind of becoming that mentality of like being a hater, right? And if you don't have a long or short position, like, you know, and you don't have constructive points to bring out around that stock, there's just no point in being there, right? That's just, you know, that's not the right place to be, okay? Second thing I want to tell people about, and this is kind of more of a warning on something I'm seeing, is be careful of a new potential FOMO cycle building, all right? So a new potential FOMO cycle building is when you have let's say a lot of stocks, maybe more speculative ones or whatever, right? Assets in general starting to go up and up and up, right? And you can start to have a new kind of FOMO cycle build, which is a FOMO cycle, meaning, you know, fear of missing out, right? And it seems like the most recent one we're kind of have starting to brew here. This was one that's led by Wall Street this time, okay? The last time it was led by actually retail money. Let's be very clear. A lot of these moves we're seeing, this is being led by Wall Street this time, and they're creating this FOMO cycle either on purpose or just by chance, okay? And it's up to you for you know whatever your opinion is around whatever that is, right? But what we know is retail's actually been very, very low on funds, very, very low on funds when it comes to having money to purchase stocks and other, you know, let's call it assets, right? And so all of a sudden, all this money comes out of nowhere. All of a sudden, like in a matter of a snap of fingers, the past week or so, into a lot of these things, and it's like, whoa, where did all this money come from? That's big money coming in, okay? And so you got to be kind of a little wary of what's going on there, because as soon as that big money decides to get out, they're out, right? They're cashing. And so, you know, just kind of, you know, think about these things, right? And this kind of leads me into point number 3 is remember your long-term valuation and stock price goals when it comes to a stock, all right? And the reason this is very, very important in this sort of market, especially if you start to have a new FOMO cycle build, is when stocks start going up a lot, you know, let's say all of a sudden you're up 20% on a position or 30% or whatever, right? You start buying a stock and all of a sudden it's up big and you're like, whoa, okay. It's very easy to take short-term profits in that stock. And the reason being is we've been through a tough market, and if all of a sudden you start making a little bit of money, you're very likely to all of a sudden just cash, right? And be like, okay, I just better take my profit and run. Remember your long-term price targets. If you think a stock's let's say you think a stock's going to double over the next 5 years, right? And so you think it's going to go up at least 100% over the next 5 years. And this is because you think it's going to this net income over the next 5 years, and you think it should command, you know, this type of PE in 5 years. Okay, right? And let's say the stock goes up 15% very quickly. Well, 15% is not very much if you expect that stock to double over the next 3 years or 5 years or something like that, right? And so it's very important to keep these targets in mind so you don't get caught into the trap of selling a stock way early. It's also important to remember you don't get caught up in that FOMO cycle if, let's say you expect a stock to double over the next, let's say 3 years, right? And then the stock doubles already, right? Well, shoot, now it's not as much of an opportunity unless the actual fundamentals are immensely better than what you had anticipated going in. Maybe that's a sign that maybe it's time to cash a little bit and take a little profits or something like that, right? So always bring it back to where you expect the valuation to go, the stock price to go, and don't get caught up into whatever's going on in the market, positive or negative, because you can't have it both ways, right? If you're also going to care about what the market narrative is when stocks are going up, then you also have to care about when it goes down. And then if next time it goes down, you have to end up panic selling and selling at really bad prices, because usually you get into peak fear. That's when the market's at its lowest, right? Peak fear happens when market's at its lowest, stocks are being devastated. So you can't have it both ways. So don't even get tied up into that, all right? Remember what your expectations are, right? Number 4, the fourth thing I want to talk about here is during a melt-up scenario, that's a great time to cash up. Okay, if you think about melt up, think about cash up. So melt up meaning if you all of a sudden you have all assets going up, let's say Bitcoin's going up and Ethereum and cryptos in general, and let's say meme stocks and a bunch of other things, just maybe the whole market in general, just all financial assets, just all of a sudden start going up. And let's say they go on a 3-month run, 6-month run, 12-month run, whatever, right? And they're just flying, and it seems like, wow, we're back to the good days again. We're actually making money and we're making a lot of money, all right? So during those melt-up periods, what I personally like to do is I like to cash up a little more. It doesn't mean I'm not going to buy stocks at all, because there could still be very undervalued stocks out there, right? But in a melt-up scenario, I'm more likely to cash up. And the reason this is important when you're in a hot market, right, which I wouldn't call us in a hot market yet. However, we have the potential to get into a hot market. If, trends like we saw today continue on, next thing you know, you're going to be in a hot market, right? And so if all of a sudden you get in a hot market and you get in a melt-up scenario, those are sorts of time periods where I like to a little bit cash up. And so to start to build out a cash position. And what we found, right, especially for a lot of retail folks that just got in the market the last 2 or 3 years, what a lot of those folks found is they weren't really ready to buy the dip, right? We've gotten almost every retail stock out there got slashed between 60% and 90%. We've seen great companies even go down, like the PayPals and the Metas and the Netflixes and companies like that, and Amazon stock didn't do anything for over a year and a half. And you saw all this play out, and a lot of stocks get hammered. Meanwhile, a lot of people didn't have funds to buy the dip because they didn't cash up, right? They didn't cash up going into that, and they were just buying super heavy as stocks were flying to all-time highs, 52-week highs, and those sorts of things. When you get into a melt-up scenario, that's one of the very few opportunities that you can actually a little bit cash up, right? And so that's something I like to do. And once again, it doesn't mean I won't buy a stock at all, because at the end of the day, if let's say there's a stock that's at $5 a share, right? And that stock goes to $7, but I expect that stock to go to $30 over the next 5 years based upon what I have their net income going to, what I think they could command for a PE in 5 years from now, and those sorts of things, right? I still have to take advantage of that deal. I still have to buy that stock, and that's a very, very important thing. Just because the market's going up at the period of time, if there's deals, I got to take advantage of those deals. Now, for me personally, I wouldn't mind at all if we got into some sort of melt-up scenario where a lot of these stocks started to climb. Of course, if they stay down, I'll just continue to buy the dip, and that's always the plan, right? But I wouldn't mind if we did get in any type of melt-up scenario, and the reason being is, if you know me, I've been buying like insane from about December through March. I've just been a buying beast, right? And so I don't have hardly any cash position now at this point in time, because I've been buying the dip, like really, really buying the dip. And so I'm in a scenario where I wouldn't mind at all if we had a melt up and I got to cash up a little bit for a bit here. That would be welcome. I can call it that. But if not, it's one of those things. I'll just continue to buy and buy throughout the year, right? That's an important part to always be in a position of power, right? You always want to have more income than you do expenses every month, so you can always buy the dip, right? And always be in that sort of position where you can take advantage of deals in the market. And when you get a melt-up scenario where everything starts to fly high, that's when you can back off a little bit of the buying. You can start to cash up and start to build a little bit of a cash position, because those melt-up scenarios only last for so long. You can get in like a 3-month, 6-month, 12-month scenario where you kind of have a melt-up in the market, right? And a lot of stocks go on some epic runs. But that ends. That's the thing. Like every time it ends, and then next thing you know, stocks chill for, a period of time. It could be 3 months, 6 months, could be a year, could be 2 years, depending upon the different stock, right? We've seen, stocks like Tesla go on like a 5-6 year chill out period. We've seen stocks like, Amazon. Amazon was basically around the same price it is today like 20 months ago. Like that's insane to just think about, right? That's been on a long chill out period. And so that's important to kind of think about, okay? Next thing I want to talk about is, since the market has been, let's call it, risk off. A lot of people haven't been wanting to take risks for a bit here until maybe very, very recently. Dividend stocks have gotten back to the forefront, right? And a lot of people are focused on dividend stocks. Now, why is that? Why all of a sudden people care about dividend stocks? Well, if all of a sudden you're not making any money from your stocks, right? And you own, let's say, growth stocks, and the stock price isn't going up, the stock price is going down. And let's say on top of that, you also maybe don't have any extra funds to invest. Well, shoot, you start thinking about, man, look at those dividend stocks. They've been performing pretty dang good. And on top of that, you can always have money coming into your accounts every 3 months, right? Because most of the great dividend stocks, they pay out, dividend money every 3 months to you. And so you start thinking, oh boy. Now, I fully understand that, dividend stocks can be very alluring for that reason, okay? But, there's some very important factors to remember here when you're thinking about dividend stocks. One is, not all dividend stocks are created equal, okay? There's going to be certain dividend stocks that are trash or garbage, right? And there's going to be certain dividend stocks that are truly great. But you got to remember, dividend stocks come with risk too. And I've been in many dividend stocks in the past that got hammered. And I've seen a lot of other folks get into some dividend stocks in the past that have gotten absolutely hammered. Just because it pays a dividend doesn't mean it's a safe stock, okay? This is very important. These business models can get disrupted as well, all right? Now, one of the good things with dividend stocks, this is a good and a bad thing, is they don't usually take a lot of risk with their business. So they're not likely to start up some costly project that, is going to take 5 years to get the payoff or something like that, like a growth company might, right? But with the downside with that is, those business models will be ripe for disruption over time. It's like a kind of a ticking time bomb where they're ripe for disruption. It's just a matter of time before they start getting disrupted. And if they don't have that sort of a company culture to innovate, to grow, then they're stuck with their feet in the sand, essentially, just kind of like, let's hope, we can defend off everybody for as long as possible so we can kind of keep our little monopoly on this industry or the sector or whatever it is going. And so you got to understand, dividend stocks come with risk as well. A very important thing to think about if you're considering dividend stocks, and always remember this, is payout ratio. In terms of, if a company has $1 of EPS, how much of that dollar are they paying out in the form of dividends? And sometimes these dividend companies will pay more. Listen to this. They'll pay more in their dividends than what they have coming in EPS, right? And do you think that's a very responsible thing? Do you think that makes the company necessarily a safe company? No, it doesn't. It doesn't make it a safe company, right? And so, and you never know what can all of a sudden come and disrupt one of these dividend stocks. For instance, I'll give you a good example of a stock, probably my worst or second worst stock I ever had in my life, okay, was Carnival Cruise Line, CCL. I started buying that right before a once-in-a-100-year pandemic. Now, CCL was a great dividend payer. I can't remember the yield that one paid me, but I think it was like 4% or something like that, right? Their balance sheet was in a plenty good situation for them at that moment in time, right? They were consistently profitable. It was a profit machine. People love going on cruises. It was, it was a beautiful business model and a beautiful dividend stock, right? And then all of a sudden, a once-in-a-100-year pandemic comes out of nowhere and the stock falls 70%, if not more than 70%. And think about that for a moment. It was one of those things, like, I even went into that and I thought about a recession scenario, right? I thought, well, if we get into a recession, there's still going to be a certain amount of people that want to take cruises. Company can probably still make a small profit. At least, yeah, their earnings will go down, but they'll be okay. The stock would get hit in a major recession, but it wouldn't be that bad. And then here you are, all of a sudden you get a once-in-a-100-year, health situation around the globe, and all of a sudden their business is completely shut down. The stock falls 70+%. And so don't ever think that can't happen to other companies that are dividend stocks. Some of these companies are not very responsible. They're not responsible to their shareholders. They're just there to pay out the biggest number possible and to attract an investor base that just wants the biggest dividend possible. But think about it this way, right? Let's say you hold a dividend stock over a 3-year span, let's say, for instance, and let's say you make a pretty good yield on your money each year, and let's say over that 3-year span you make 10% on your money from dividends, right? Awesome. Well, what if the stock fell 15% over those 3 years, right? The company started to kind of deteriorate. It's not commanding the same PEs it used to command because their revenues are starting to fall. Then maybe their net income's starting to fall. Their margins are starting to fall because they're being disrupted, right? Well, ultimately, that was still a horrible investment decision because now you're down 15% over a three-year span on the stock price. Just because you made 10% on dividends over that 3 years, you're still down on the stock over a 3-year span, right? And so this is something important to remember that people don't think about. And sometimes people get caught into the trap when it comes to dividend stocks is like, oh, they see like let's say a 7% yield or a 10% yield. And they're like, oh my gosh, I can make 7% a year on this stock or 10% just for holding it. A lot of times those same stocks will fall 7 to 10% of that year as well. And think about it this way. Even if the stock price doesn't move, you basically just kept up with the market, right? Because the market you can usually expect to go up like 8% per year roughly, right? And so remember, the higher the yield is, especially once you get over a 5% yield, definitely be very, very careful of those. Lastly, when it comes to dividend stocks, remember, there's been a lot of money, right, that has flooded into dividend stocks over the past 6 months or so. As the market got rough, where do people like to hide out? They like to hide out in big tech, a lot of the bigger companies in general, and a lot of the dividend plays, right? And so that puts all their valuations up, and you might say, well, this is a good place to hide out. Well, the market doesn't stay in those risk-off periods forever, and so all of a sudden you can end up in a situation where those stocks actually start to underperform the market, underperform the benchmarks actually quite substantially, and meanwhile growth stocks kind of go on a flying race. Generally speaking, when the market is in a hot period, it's going through a melt up, it's usually when you might want to think about at least flocking a little bit of money to not just cash, but also some dividend plays. And then when the market is risk off and no one wants to take risk anymore in the market, that is usually the time that you want to say, now's the time I need to be in some more of the growth plays, because those are usually the ones that are already beaten down. If no one wants to take risk, the growth stocks are the ones that are sold off the heaviest. And so do keep that in mind in the future, because you're going to go through these time periods where the market's melting up. That's a time you need to maybe lay off a little bit of the growth stocks, go a little heavier to divs and cash, and then you're going to have these periods where the whole market just is getting obliterated. That's where you want to be a little more aggressive, actually. And it goes against conventional thinking, because conventional thinking says, oh my gosh, everybody's scared, I need to be in dividend stocks and the safe plays. When actually, if everybody's already scared, you're likely close to a bottom, which is going to rebound, and the growth stocks are what rebounds first, right? And usually what conventional thinking would think is everybody's excited, there's FOMO in the market, all these stocks are going to 52-week highs, all-time highs, I got to be in the growth stocks, I got to be in the riskier plays, and that's actually the time you need to dial back. Because if everybody's already in that mindset of just pure excitement and euphoria, you're just a snap of fingers away from that baby flipping, okay? So yeah, I just said a bunch of stuff there that needed to be said. Hope you guys enjoyed this. Always hope you got some good value out of a video like this. Let me know in the comment section if you did. And other than that, guys, much love as always. Thanks for joining me. Don't forget to subscribe and have a great day.